Mr. Cole Smead, good afternoon. Thank you very much for doing this.
Yeah, thanks for having me.
For the listener, you are the CEO of Smead Capital Management. What is Smead Capital Management?
Yeah, so what we like to say is we advise investors who fear stock market failure, and we do that through a low turnover, differentiated value discipline, seeking wonderful companies to build wealth. We're really a mutual fund company, both in the U.S. and outside the United States, and we run an international and a U.S. equity strategy for what would be typically advisors, family office, institutions, and yeah, we feel pretty blessed to do what we do.
How'd you get into investing?
Well, I took the cheater's way in, which is my dad had gotten the investment business in 1980, and so because of that, I had a lot of interactions. I'll never forget being a 7-year-old kid. In first grade, they let my dad come in to teach your parent, teach your classmates what your parent does, and so my dad comes in and he's trying to teach people about stocks, and I'm the only 7-year-old that knew what a stock was. By the way, I would say I had a huge competitive advantage at that point in life. But I was always enamored with this idea that you could buy something and it could go up in value and you didn't have to do anything. And those benefits accrue to you. They could be mutually exclusive to you because you're the investor in it. And just the power of common stock investing. And that was, incredible to me. At the same time, I didn't know always that I was going to do this for a living. I was, intrigued by money. I would think it's something that's always interested me. But I didn't know if maybe I could play Major League Baseball or go fly Navy jets. And this just ended up being what God wanted me to do. And like I said, I feel really blessed that this is where I ended up.
You have a investing influence or style, maybe a classic Warren Buffett, Ben Graham value style, or a growth style from sort of thing, or how do you think of it?
Yeah, I think of it as primarily, to your point, it's in a Ben Graham or Buffett ilk, but really, I think of a lot of about Munger, his idea of ignorance avoidance. Okay, in other words, ultimately, what you're trying to do in investing is not do stupid things, and the most common way to not do stupid things would be to just not overpay. Right, so that would be my ultimate bias. I don't want to overpay for things. I don't mind paying fair price for things, because if it's going to grow wonderfully and it's got great returns, you should be willing to pay that. But the goal is to not overpay. And so that's really where, our value bias or my value bias comes from. I also think another thing that has really guided me, I think of books like John Train's The Money Masters, which is a wonderful book that's out there, was written obviously many, many decades ago. But in reading that, there's stories of Buffett, there's stories of people like like the Tisch family, for example, who owns the New York Giants. But one of the stories they tell in there is about T. Rowe Price, who was one of the greatest growth investors of the 1960s. But what was interesting about reading the book with T. Rowe Price is that he was willing to go ultimately wherever he needed to. So he went from being this great growth stock investor with companies like Texas Instruments and other businesses that were, fantastic businesses back then, to pivots in the 1970s and wants to buy like natural resources stocks and gold and all kinds of commodity oriented businesses. And he actually had done that after he left T. Rowe. And, you don't really hear of anything T. Rowe after that, but it seems to be that he did remarkable. And yet it's one of those things kind of left in history. So I find that interesting because, who wants to be a great investor and then who's willing to do whatever it takes to be a great investor? And sometimes that means going to people and saying, yeah, I said I never thought I'd like these businesses, but by the way, they're really attractive now. And I think that's something that never saying never is another thing that I've learned a lot in my career so far.
Does Smead Capital run a active portfolio or is it fairly passive? How do you manage it?
Yeah, so we run concentrated portfolios of 25 to 30 securities. We also run low turnover. We think turnover, it can be a dangerous thing for portfolios because humans don't deal with change very well. So as we like to say, turnover, it's kind of like a bar, your portfolio is like a bar of soap. The more you rub it, the less it becomes. So we tend to run, usually 15 to 25% turnover on average. We tend to be more active in years where there's just a lot of tumult in markets. So like think of, 0809, think of 2020. We're just going to be more active in those times because we get, our opportunity cost, it looks more attractive for us at those moments. And yeah, we think, like Munger says, you're going to have, a lot better success in your best idea than your 20th best idea. And we follow that principle. So usually our half our portfolios are our top 10 names.
At the start of the Berkshire Hathaway report, the scorecard for Berkshire, so to speak, is the S&P 500. What would Smead Capital's scorecard be? Do you have a benchmark that you compare the fund against?
Yeah, I would say, in our U.S. equity portfolios, we benchmark against the S&P and like the Russell 1000 value. We look at those as guideposts, right? They don't tell you necessarily how you should have done. Also, this is a lot like the game of golf. It's you versus you, right? It's you versus your own mistakes and shortcomings. And so you might have beat the S&P, you might have underperformed what you should have done. That's how I kind of think about some of these things. In our ex-US portfolios, we use like the MSCI EFA, we use the MSCI ACWI ex-US, or like the MSCI World ex-US. If someone said which one should you use, I'd say whatever one you prefer to use, but they don't really ultimately guide what we do in investing. So again, they're just like they always were intended for. They're just kind of benchmarks for understanding, what people should have possibly or generally done in some of those spaces.
Naming a firm after yourself is one way to have skin in the game. Do you also invest your own money in the funds to create a symmetry of risk with your clients?
Yeah, I have a new term for thinking about this. We're terribly tribal. Okay, we're very tribal. And what I mean by that is, so Bill and I, we have all of our net worth, liquid net worth, sitting in what we do for our investors in both those strategies, and we own them, just so you know, through our mutual funds directly, commingled alongside the other investors. Now, why? Because we're skin in the game people with the companies we evaluate. We want managers and insiders that think like owners. And the same thing is true for us. Are we going to be better investors if we take part of our capital to something else? The answer is no. If I find something attractive for me as an investor, why wouldn't I be buying that for our own investors? Those are just conflicts that we long decided ago that we're not going to have, we're not going to want, we're not going to seek out. So beyond those, are what we own in our active strategies via the mutual funds. We own Smead Capital, which is like a levered bet on those. And so we just think that's the right way to go through the world. It doesn't mean it works for everybody, but it's just how we've chosen to be in our tribal sense. We have a growing tribe. There's a lot of people out there that, expect us to lead them in what we're doing in this tribe. And we want to be the right people for the tribe.
The purpose of Smead Capital is to create value for your clients. You invest money to make more in the future. So your job is to find undervalued investments. Where are you finding value these days? Where are you looking? Is there a particular sector that you're focusing on?
Yeah, we tend to congregate ideas when we get, good ideas in a space. It tends to be one, and then you learn more about the space and you continue to get more involved. And so, I think the energy space at large has just been a big place for us to go out, allocate capital, take money, find new things to dig on. And I say that because so during the 2010s, we owned nothing in energy. In fact, in the U.S. side, we sold our last energy holding, which was a Chevron in 2010. Okay, so not until late 2019 did we actually get involved again with the energy space. So I point that out because we can go a long time just being completely missing from a space. And if you ask me in the mid 2010s, hey Cole, what do you know about the energy business? I'd say, well, I know they're wasting a lot of cash flow. I know they're spending a lot of capex. I know that free cash flow is in decline. And I know that balance sheets are very tight because of all the capex going on. Okay. That's all we really knew. We just knew how it didn't really fit our 8 criteria. Most of what we use our 8 criteria for common stock selection for, it's a negative art. You're trying to eliminate things. You're not trying to show that they prove out. And so I say that because it really wasn't until late 2019 where it was tough to fail things. And that's where we started doing a lot more of our work, was when we couldn't fail these companies. I think that got even more interesting as we rolled into the spring of 20, when you're looking at negative oil prices, and suddenly all these oil companies that could drill and drill and drill, they found God, surprisingly. And people said they never would find God. And you know what? No, they did. And what that produced was really the rationality that we see through to today, which is that they're not wasting money drilling. They are actually willing to drive significant amount of free cash flow. And ultimately, that's what drives business value over time, in our opinion, is huge creation of free cash flow. And then the correct allocation of that capital back into the business, back to the shareholders, or buying out minorities that shouldn't be there. And so I think that's something we've learned. I think, to our discussion right before this started, you can do that via books. A pivotal book for us to read was The Frackers by Greg Zuckerman, who's a writer for the Wall Street Journal. Greg's book was written in 2013. It was really a high point in the energy business. And so it was interesting to think about, okay, where were we since then? 7 years later removed, who was right, who was wrong? Who did you want to be pot committed with that whole time? Who did you not? And I think the character out of that book that we really gravitated towards was Harold Hamm in Continental Resources. The book actually opens with him at I think it's if I remember correctly, the name of the hotel is the Brown Cow Palace in Dallas or in Denver.
Mm-hmm.
And I've been there before. I've had breakfast there, and that's where his roadshow began to take Continental Resources public. And the reason why we were interested in him is because it didn't matter really the life circumstances that Harold had begot in Enid, Oklahoma. He was going to succeed and figure out a way, even if he had no clue. We think a lot about incentive structures, and I think that taught us a lot because at the time we were reading that book was the Wall Street didn't think they were going to make it through the circumstances with all the debt they had built up. And reading the book, you didn't get the sense that he was ever going to fail. But the second thing is he had billions and billions of dollars net worth with over 80% of their company. And so the idea that he would give up on his net worth for a missed bond payment or something of that nature, that seemed very frivolous and unlikely. So I think it really highlighted in our mind when someone's running a quant screen, the qualitative things that can be missed. Do you in a quant screen, do you necessarily pay attention when someone owns over 80% of a company? No, you might just be running return on equity, some valuation metrics, some balance sheet metrics, and you wouldn't pay attention to the shareholder register and who sits there. And so I think, yes, I loved reading that book. It was a great book. It kind of excited your imagination for what goes on in the space. But I also think it did teach us about, who you want to be involved with. For example, we couldn't figure out for years why Chesapeake Energy didn't go bankrupt earlier. That was kind of a shocking thing to us. It eventually did. It's reorganized, and I know their business has done a lot better now. But the debt built up in the prior era from people wasting money was something that had to come home to roost.
One of the reasons that energy has been undervalued lately, among others, is the ESG pressures, where in simple terms, the idea is to decapitalize energy companies, create the cost of capital go higher, and make it tougher to do business. So in your opinion, has the ESG pressures created mispriced opportunities in the energy sector for investors like you?
I just think it's exacerbated the space. So let me explain. Why did energy do so poorly to 2020? And the answer is they produced really low returns on capital. When I'm looking at returns on capital, if you take the free cash flow that was produced in the space, based on the equity capital that they needed to run their businesses over that decade, it was a total nightmare. Okay, so it's like running a class. First thing we need to learn: when return on equity is low, multiples that are paid for those businesses are going to be low. I mean, it's very explicit. So then you take that, you get done with a really bad return era in these businesses and say, oh, by the way, there is this new idea that's out there called ESG, and we have really no way of proving what's valuable in it. We just know that some people want to do it. We know that Wall Street wants to market it, which they're always good at marketing what's ever sellable. So that's just going to cause more pressure on these businesses. And the answer is yes, they feel that pressure from plausible situations where people want to divest, particularly European investors wanting to divest, Scandinavian countries, et cetera. That's where we've seen it institutionally, particularly in that neck of the woods. But what I think that's like in physics, for every action, there's an equal and an opposite reaction. That's the equal reaction. People divest or move away from the space. The opposite reaction, though, is it creates a bargain opportunity for people that haven't lost their mind. Okay. So just so you know, Trevor, I love ESG. I love it with all my heart. It's the greatest thing that's ever happened to me personally, our investors, my career, because what is really going on is people are saying, listen, for non-economic reasons, I'm going to not own this space. And the great part is my brain only thinks economically. And because of that, I think there's a lot of money to be made off that. And I also think could someone say, oh, the Ukraine war made people think about that differently? Plausibly, but I think there's something really going on deeper than just like, how do we define this? I think there's just some people that think it's an existential crisis and therefore they're going to do whatever it takes. But I think the only danger in that is, like, to quote Charlie Munger, he says, we don't know whether the sea levels are going to rise 2 inches or 20 feet. We actually have very little data to prove anything. Okay. We like working on concrete data and a lot of it. We like thinking about things that, like we talk about not overpaying. Why would you not want to overpay? Well, there's voluminous data to argue that not overpaying is beneficial to long-term investing, right? That's not some secret that we woke up with yesterday, but I just pointed out because there's a lot more theory going on with ESG than people know. And I don't care if someone has more degrees than Fahrenheit and they say it's a valuable thing. Academics are terrible investors. And that's the wonderful part to this, is the people with more degrees than Fahrenheit are actually doing a pretty good job of shepherding people into hell, not heaven. And even beyond the oil and gas space, we're buying coal stocks, like in places like South Africa and Australia. That's adding pressure to where what's going on is, rather than worrying about the cost of capital, these businesses will just sit on cash. Why worry about who you bank with when you don't need banking? I think that's becoming a common thread because, again, they're going to sustain, they're going to adapt. And the idea that there's going to be no reaction to this and that the cost of capital is going to ruin these businesses, no, because their demand is growing for things like oil and gas or coal. And when you run into tight supply because no one wants to get into these spaces, particularly for ESG reasons, you can get really good economics. So finding coal businesses that if you net out their cash, they can make 60% return on equity, that seems like fantasy land. Nope, that's called 2023. You and I live in it, and we get the profit from it.
The flip side, I guess, the argument from the quality growth camp would be that there's no catalyst to create value in these undervalued energy stocks. They're a value trap, and that you're not going to get your money back. What would your response be to that?
Oh, I love the quality growth camp. They're adorable. It's really cute. So let me, this is good. By the way, this is the debate. I think this is the whole ball game, just so we're on the same page.
Mm-hmm.
Okay. So let me, and I don't want to butcher the title of this. I believe that the title of the work is called Patient Capital Outperformance. It's written by Ankur Parikh and Martin Kremers, who did, Kremers and Petagiso did the original active share work. And then Parikh and Kremers did work at looking at active share and turnover. And what they found is, funds that have low turnover and high active share, aka differentiated but hold their winners, kind of a thing, end up producing all the alpha. So they then went in and said, okay, of that quartile of the two-factor model, what else can we see in that quartile? Two things they found: the value premium, and the second thing they found was what Cliff Asness has been arguing since I think 2013 is QMJ, quality minus junk, or what we know as many people refer to as the quality factor. Okay, so now here is the ball game that I'm getting at. Are quality and value mutually exclusive? That is the game, okay? Because ultimately, I would argue that the quality people are saying, like, if you want another book, Jeremy Siegel did in Stocks for the Long Run, it doesn't matter how much you pay. In the long run, you'll end up doing fine, which is why he looked at the Nifty 50 from the peak to 25 years later, and he said, see, you almost beat the S&P 500 over 25 years. Now, here's the foolishness in that, Trevor. If you and I ran a strategy that almost beat the S&P 500 over 25 years, we would not be in business. We might be sitting at a bar unemployed 10 years later and laughing about our foolishness, okay? And again, it heightens the difference between academia and the real world, like I said earlier. So here's, if I had to give someone a guide of what's likely to play out over the next 10 years, I would use the Nifty 50 as my guide, okay? And I'll give you some tangible examples of this, okay? And by the way, back to, I said Europe's been much bigger on ESG. Europe owns the quality growth story way larger than US investors do, in my opinion, from what I've seen, okay? That's where kind of the Lindsell Train world has been. That's where the Terry Smith world has been with Fundsmith. That's where, and I'm not saying there's not US people participating in that. There are, but I just think it's more damaging there because in bad stock markets in Europe, they went and sought that out in America in just an incredible way. So let's use Coca-Cola. Coca-Cola was one of the marquee companies of the Nifty 50. If you look at what Nifty 50 companies did well, Philip Morris, Disney were the winners. There were others like Simplicity Patterns, which were no debt, high ROE businesses that disappeared. Why? Their product wasn't a need. So people also forget that some businesses go away because we find out that they're actually not needed. Simplicity Patterns, they were making sewing patterns for the booming business of sewing, right? Women knitting. That's what they did. Now, Coca-Cola in comparison, we know was going to grow a lot the next 25 years. But here's the catch. Coca-Cola had no debt. They were producing like 20% return on equity, which was a really good return on equity for a company at that time. And from 72 to the end of the 1970s, they lost 55% of their market cap. Okay. In 1980, you could buy that stock at 6 times earnings with a 5% dividend. And there was not a soul in the stock market that cared to buy it. Now, why? Here's where the quality growth people are wrong. It had nothing to do with the quality of the business. The quality stayed superb. How you would identify quality, the capital structure, the consistency of the business, the returns on capital, those all stayed perfect. What changed was the multiples that people were willing to pay. Dogs chase cars and people chase stocks. They run after them on the way up and they run from them on the way down. And that will never change in my lifetime. So ultimately, the quality growth people are just way overpaying for businesses. I'll give a current example. We used to own PayPal. We owned it from the eBay spinoff. And that has historically been a quality growth, kind of space. And we were reevaluating PayPal the other day because we sold it off over years in most cases at prices at similar or higher than today. And so we wanted to come back and ask the question, okay, what's changed in this business? Are the returns on capital attractive for us? And what blew our mind was here we are sitting with an asset-light business like PayPal, and it's only producing like 15 to 20% return on equity. That's terrible return on equity for an asset-light business. Why are they not running like 30% return on equity for such a strong business? If you go look at Adyen, for example, Adyen runs way higher return on equity. And really what it comes down to, it looks like to us, is PayPal has a great transaction business for online retail. You're a merchant, you want to get people checked out. Great. PayPal checkout works wonderfully. They also own Braintree for transactions, big enterprise size transactions, but they don't make much money off that. And then they own Venmo, which Venmo has a pretty highfalutin, group of people using it, and yet they make no money. In other words, they have quite a bit of the assets in their business that there's actually no return on capital. Okay. Now, how do you rectify that? That's really tough. It's really tough to figure out right now how you rectify that. And that should be a business that's producing higher returns on capital. And people still can remember when the stock did well. And what we're running into now is where, it's, we get 2 or 3 years into this where people can be like, when was the last time that thing had success? And it shows that in their case, they might not actually produce the return on equity that people thought they would have as they grew going forward. There could be other businesses where they continue to do just fine on their returns of capital, produce 30% return on equity. But in that kind of return on equity, you have to compound money in such a way where you can't overpay for a business. Let's say if I do the math, that means every 2.5 years, roughly, they'll double their book value. Okay. So that means over 10 years, they'll 2, 4, 8, 16 fold their book. But if you're paying 9 times book for it now or 10 times book, what's your probability of success? And that's in many cases the multiples being paid for those businesses. So I think it's really, it is Ben Graham's like price is what you pay, value is what you get. How do you really look at value? Value is your ability to grow your capital. And the primary way a business does that is through the return on equity of the business. Or if someone wants to look at, say, return on invested capital or something of that nature, that's what the quality growth people tend to look most at, is return on invested capital. That's how we think about that price versus value lever. If a business can, grow our capital a lot more internally, we're willing to pay more price for that, as long as we're not overpaying. And I think ultimately their problem is they've way overpaid, and there's really no way out, because the other thing that they did in a very damaging way, Trevor, is they went and told all their investors, I'll never own this. I'll never own that. That space is something I'll never touch. If you came to me 10 years ago and said, Cole, what if I give you a circumstance where you can own an asset intensive business that's commodity oriented, that can produce 30% return on equity? And here's the catch. You don't even pay 2 times book for it. I'd say, well, the commodities might scare me a little. The asset intensive business isn't what I prefer, but holy crap, if you give me a business like that, I'm in.
Yeah.
And it just so happens that sits in the stock market, the oil and gas market right now. But those investors, those quality growth investors, have said, I will never own those industries, those sectors, those businesses. And by the way, many because of their asset-light nature and their strategies, have gone out and pitched the ESG thing to where they have to stick to that now. And the great part is they have themselves chained down to expensive companies with really good capital structures and really good return on equity in most cases and really good businesses, but they won't have success with them.
One of the common responses to the concern of a value trap has been that the energy sector is generating actual profits these days, and that profits are the cure-all, and that come out in the wash eventually.
Well, yeah, they think it's not sustainable, right? So using the 2010s, it wasn't sustainable. Now, why do I say that? Because supply grew and grew and grew, particularly in U.S. shale. That's U.S. shale ended up becoming a massive swing producer during the 2010s.
Yeah.
I was in London for a meeting. This is about I want to say about 7-8 months ago, and someone said, Cole, are we past the peak of oil? And I said, well, what I tried to kind of ascertain what they're getting at. They said, well, production isn't growing. And I said, well, if you're asking, are we at peak production? I said, in the interim, we are. We're going to tumble production looking forward probably over the next year or 2 years. Now, the question is that a bad thing? As an investor, I think that's delightful, okay? Because what you want is you want something that's scarce, that has strong demand. So you don't want other people to do what you do. And to your point, because they're so interested in producing a profit, they're unwilling to produce new supply. Okay. Yeah. So would we rather go back to a world where supply would grow, returns on capital were poor, there was no free cash flow? Or would I rather wake up in a world where they're producing profits, they have nice returns on capital, and supply is dwindling? I mean, there's just no question. So, we want scarcity. You can apply this out to the coal businesses we're buying. Are there new coal projects getting approved in Australia and other countries that have historically produced those kind of assets? And the answer is no. No, they're not getting approved. Now, as a financial investor, which that's what we are, do I care? No, as a business manager, you might care because you might have some incentive to grow a bigger kingdom at times. But as a financial investor, we want scarce supply running into attractive demand, because what that means is we will over earn what we normally would because of the supply demand dynamics.
Most people would agree they'd like to live on a greener planet too, which is kind of the well-meaning intentions of the ESG movement. Yeah. Unfortunately, what's currently happening and what's being brought up by people right now is that a lot of the ESG pressures are defunding traditional energy businesses, which are actually producers of clean tech patents and technology and technology that can make the planet greener. Do you think that more funding into traditional energy businesses might actually help create progress in the green movement?
Yeah. So humans always solve the problems they want to solve. It's just the nature of humanity. So for example, Trevor, you said, listen, Cole, I'm an atheist. I don't believe there's a God. You will prove to yourself there's not a God. If I say, hey, Trevor, I believe there's a God, I'm going to prove that. It's just that way we're made. We're always going to prove what we want to prove, even out to the point where it might not be true, but we've proven it to ourselves nonetheless. We believe it. Okay. So I actually think a lot about where we're going the same way. So for example, if we deem as a global society that carbon in the air is not a good thing, we will solve carbon in the air. Now, like physics though, equal opposite reaction. Okay. Let's say we are able to take carbon out of the air. Well, who benefits from that should be the second question. And the irony is, I would argue that who benefits are carbon businesses, not renewable businesses, because then sunk costs are sunk costs, and you're going to continue to make carbon and pull it out of the air because you've proved yourself successful at doing that. So again, I think that's, it's kind of like the unintended consequences of what we want to solve. That's partly what I think about as we talk about this discussion. Now, let me add one more thing, and this gets back to kind of the Munger ilk that I mentioned just a second ago. Munger says, we don't know whether it's going to be 2 inches or 20 feet that the sea levels will change. And he also said, hey, if you're into nonsense, it's a field for you because there's a lot of nonsense. Okay. One other thing that hasn't been mentioned is the world has actually got warmer. The question, is that a bad thing? I'll give you an example. The history of the last, I'll call it, say 4,000 years of humanity has been in years where things are cold, we tend to have starvation. Okay. So if someone says to me, Cole, on the margin, would you rather be in a warm world where we have more abundance of food, or in a cold world where more people starve? I'm on team humanity. I want humans to flourish. I don't want a single soul to have more trouble. So I find it interesting that you look at like starvation and world hunger, we continue to solve those things in a remarkable way compared to 30, 40, 50 years ago. And yet it's coming on the back of a warmer world. And the question is, correlation isn't causation, but we do know that plants love carbon. We do know that plants do better in warmer climates. Okay.
Mhm.
And so I just point that out because no one talks about the benefits of the world that we are in today. And I think those are distinctly keen benefits. If I go to parts of the other side of the subject and say, gosh, the trees have got to be elated. They have tons of carbon to eat and have as nutrients. Some people would say that that's crazy to say, but it's just the truth and the reality of the situation. We own lumber companies up in Canada like West Fraser and Interfor, and there's just no question that those companies love carbon getting stored in trees and then harvesting them and then creating young trees to go out and effectively capture that carbon again. That's a great part of capitalism, is we can go out and seek profits with businesses that want to go seek this out. And I would say one last way of thinking about the subject. In the United States, from when the Pilgrims landed on Plymouth Rock to about 1920, we had devastated 30% of the forest of the United States of America. So we had been effectively depleting our forest. From 1920 to today, but really from 1985 to today, we've completely repleted the forest of America to where we have more trees in America today than we did when the Pilgrims hit Plymouth Rock. Now, by the way, nobody says, good job, capitalism. Good job, democratic society. Good job, Team America. But that's the reality of the situation. And so I just point that because, again, humans solve the problems they want to solve. We're a benevolent capital society, using Canada and the United States. And I think we will solve the things we want to solve. And what ends up happening is we continue to do the same things we did prior.
The general economy right now, a lot of investors and economists are saying the yield curve is inverted. Is the yield curve inverted? And do you believe that's an accurate way to predict a coming recession, or is there a recession coming at all?
Yeah, so I don't think the yield curve has been very indicative, other than telling you that the yield curve is inverted. I mean, it's a prima facie thing. So, we've been in the camp that what the U.S. government particularly did relative to even other governments of the world, in tandem with the low interest rate environments that all the central banks of the world produce, it would be akin to a man impregnating a woman. The federal government threw out trillions of dollars of stimulus cash. And so this man impregnates this woman. The woman's about to have the baby. She has the child. And then he comes to her and says, you know what? I want you to just put the baby back in there. I don't actually want that anymore. Mm-hmm. Okay. That's what it's like to ask Jay Powell or other central bankers to try and put the baby, AKA inflation, back to where it was. It's impossible. Okay. She's impregnated. There's no stopping that. And that's the reality of the situation. So we look at Jay Powell and say, hey, has he done a perfect job? I would say no. Has he done a pretty good job, best as anybody could do in that situation when you have political issues around you? I would say yes. But the reality of the situation is it's just very tough to get rid of, there's currently still $1 trillion of cash sitting out there from stimulus in the US economy as we speak. How do you deplete that? Time depletes that, but it's very tough to do that through the blunt tool of interest rate policy. One other thing I will say, the consumer of America has really been the forte coming out of this and continues to be misunderstood. A couple things about that consumer. They sit on higher cash balances than they've ever really had. The excess savings out there is remarkable. So where can you see that right now? Go out and book vacations. Try to book a vacation in 3 months. Good luck. Yeah. Maybe 6 months, more likely 9 months. But I just point that out because that's really where you can see this manifested. Wealthy people have a lot of cash. But then the flip side of that too is if you look at lower end wages are doing wonderfully. They're outpunching inflation. The two bottom income quartiles in America are producing the highest wage gains. How bad can the economy of America be when the poorest people are winning the most? Mm-hmm. I don't think they can lose in that scenario. what we're really seeing is the reversion of economics, where the 2010s where the rich get richer and the poor get poorer. Now the rich are getting poorer and the poor are getting richer. And people are just kind of chagrined because the stock market's made up of wealthy people and they don't like that. Okay. So I think that's really at play. One other thing I'll add, you've got to remember the largest consuming age group in America today is millennials. Okay. So you put all this stimulus out there, the Fed and the government are like, oh, it's not going to cause a lot of trouble. In the last 20 years, we haven't had any trouble. Oh, by the way, it happened to run to the biggest consumer we've seen since baby boomers in the 1980s. So now we have this consumer who likes houses. 10 years ago, they didn't. They're starting families. 10 years ago, they weren't. They're consuming a lot of cash, and that stimulus money is just feeding that. So I got married when I was 24. I was born in 1983. So I get to kind of see the early cusp of this because I got married young and I'm early on in that group. It's like, what your credit card's going to say before the month starts. The spending hasn't even begun. That's the kind of consumer we're dealing with in the United States economy. And that's completely outside the Fed's model, in my opinion.
No recession coming, in other words.
Well, I would say this. Like we've already seen, the recession that comes is going to be a spillover of what happens in the capital markets into the real economy, not the real economy itself. So, for example, what we saw in regional banking, for example, that was a capital markets spillover into the real economy. That was not the economy's problem. That was banks that were doing stupid things on their balance sheet that thought that low rates were going to be here forever because they're good, omnipotent ship Captain Jay Powell was going to help them ride out the storm. And the reality is everyone's got a plan until they get punched in the face. And that's what happened to some of these banking institutions. Commercial real estate, it will be terribly interesting to see how that messy story plays out. We're probably the most negative people you could run into on that. And I've been maskless in an office since July of 20. I like going to the office, and I think that looks like an utter hellhole. So that doesn't mean regional banking's not done. But again, it's where capital market issues like that spill over into the real economy. And the question is, how do they change things? We're here in Phoenix, Arizona. How Phoenix looks right now, housing market continue to look really strong. That's a consumer-oriented market, even at higher interest rates. If you go look at commercial development, it's tough for people to get multifamily apartment loans right now for development. So you can see where the consumer is, things are fine. Where capital markets and investors need to meet to touch the real economy, that's where the issues are right now.
These are complex systems, and oftentimes it's just not worth your time, or it's just not effective to make predictions on things like this. In your experience, has it been effective to try and predict macroeconomic issues, or is it worth your time?
Yeah, so I kind of take the John Templeton tack on this. You should, when you're thinking about predictions, you should never ask like, where do things look the best? Because I think that's where you get the biggest damage. Because where things look the best, you can often be wrong. Like Templeton said, he said, you should be asking where things look the worst. And that's where you should start, because you're just starting with much lower assumptions. Psychology is always the biggest thing at play in any given times, particularly at extremes. I was just sitting with our interns earlier today, and I gave them each a copy of A Short History of Financial Euphoria by John Kenneth Galbraith. A wonderful book, great book. It really deals with the psychology extremes. And I point that out because that's really something that is tough to price, tough to think about, but you can feel it, you can hear it, you can see it at times. So that whole issue, I think, looking for where the psychology is the ugliest. So I just came across an article. Here we are buying a company in South Africa called Tungala. That's one of the coal businesses we're buying. Okay, go out and look at what the public reports and media publications are saying about South Africa right now. Okay. The article I just read this week said that pretty much the businesses are taking on their expense statements, certain public services, just to get their business ran. That's how bad the government is in South Africa today in the financial situation. What do I love about that? Well, that's one possible thing that could keep people away from buying that company today. When they're writing the story about how great you are and how good things are, that's when you know you're going to have a lot different circumstances going forward. It probably means that you're dealing with higher valuations than all things equal you'd like to do. It's like Buffett says, you pay a high price for a cheery consensus. And that's why I think what Templeton said really has you think about, well, where are expectations low? And therefore you're just taking less risk.
You read a lot of books, and you have a podcast surrounding good investing books and all the rest. It's easy to digest information all day and read from others and kind of synthesize everything. But how important do you think it is to do your own thinking and come up with your own conclusions and your own investment ideas? Is there a tension there between reading others and coming up with your own ideas, or how do you think of it that way?
Yeah, I think there's a real danger in reading too many financial books, if that makes sense. Okay. Like we were talking about, like when I want to have like my white space, free mind thinking, I pull out Hemingway. Why? It has like nothing to do with what I do day to day. Now it has to do with some places and, oh yeah, I could maybe want to visit some of these places, but it's really just kind of like free range thinking. It's like going for an open road drive where you're just kind of staring into beauty and just taking it all in. And I think that's a very valuable thing. I think the liberal arts nature of what you learn. So for example, we got a podcast coming out soon from an author named Peter Stark. His book is called Gallop Toward the Sun. And it's the story of the Shawnee chief Tecumseh and William Henry Harrison, who became president. Little Jeopardy fact, he was the shortest president by term. He died within weeks of entering office. Okay. But it tells the story of what it was like for them to interact between, kind of the Western front of the United States during Washington, Thomas Jefferson, and President Madison. Okay. Now, if you told me, Cole, what does that have to do with business? Like, what did you learn from a business perspective? I'd say, well, like I said, we're tribal. Be part of a tribe. Like, have your tribe. Know what you believe, and don't care about what other people are doing. In other words, like what your tribe does has nothing to do with someone else does in their own tribe. Okay. Other things, always have good advice. If the biggest thing I wanted to do for Tecumseh in the story was like, gosh, he just needs a really good lawyer, and we need to sue the United States government or sue the provincial government, the territorial government. But he didn't. Okay. I found countless good stuff out of lawyers in my business career, where the more lawyers I pay, the more success we've tended to have, because it means that we have good reason to go seek that counsel from those people. Those are the things that I took out of that book. If you said, did I learn something about investing? I'd say, well, I haven't figured that out yet. In other words, you're kind of, you're learning to learn is what you're doing when you read. And I think that's the really fun part to this. The next book I'm beginning to work on is called Cage Kings by Michael Thompson, another book that's about to come out. And it's the story of UFC fighting. Okay. It has nothing to do with Shawnee Chiefs or presidents. In some ways, it's kind of like, at one point, it was kind of like the Dredge Society who were interested in that. But it's just completely, it's the first sports book I've read for our podcast. Again, you're just learning a lot about a lot. It's a hark at academia. I'll quote Nassim Taleb, who's a really good book, really touches at my heartstrings. Skin in the Game. Highly recommend that book. I mean, like you could read that book and you could find a lot of truths for life. He said, to quote him, he said, in academia, there is no difference between the real world and academia. In the real world, there is. And I point that out because I think that's what you're really trying to prove, is that you know a lot about a lot, versus academia. They know a lot about very little, right? They have their field. That's it. They know so much about that field. And the problem is that might not apply to anything else in life. And that's why you want to be very liberal in your thinking, very liberal in your learning. The other thing I'd always recommend to investors, write, because you take all this information and you think of, you get information, you're trying to build knowledge, but ultimately what you're trying to attain is wisdom. Okay. And the way you attain wisdom, in my opinion, is you order your thoughts better than others. And that would mean taking a lot of information, learning a lot of things, gaining that knowledge, but then writing to build your wisdom, really ascertain what's important about what you're learning. And so we write a lot, partly because it's a good part of the investing process. So I always recommend to people, if you're reading, don't be afraid to sit down and write, even if it's just for you to share with someone. It really gathers your thoughts.
This is a investing oriented / business entrepreneurship podcast. If you were to leave the listener with a few book recommendations, what would you suggest them? Maybe 2 or 3 to start with?
Well, the ones I've mentioned are really good, but if I was going to continue to go down that route, when I'm touching at this liberal arts idea, the book I would recommend to kind of like really explore that idea is Robert Hagstrom's book, Investing: The Last Liberal Art, because he really advocates for that idea of liberal arts education. I believe this so much so that my kids go to a charter school, a government-funded independent school here in Arizona. It's a classical education school. I'm super jealous that I never had that, where it's like my daughter came home and she could quote Mark Antony's speech from Julius Caesar. super jealous. So I would say be as broad as you can in your learning. I was an economics history double major in college. I really liked my history major. I think the great part about history is you have to be pretty liberal. You have to be pretty unbiased because you're going to learn a lot about a lot. You're going to learn about the customs. It's like, I want to have wampum belts. I think wampum belts are like the coolest thing that the tribes had. And so learning a lot about these kind of things, fashion, the oratory of Tecumseh. He was quite a well-spoken person and an orator. I think those things are indelible. If I was going to throw out a couple I'm trying to think of really meaningful books that I've touched recently here. One other thing, one other book I'd give out to you, The Economics of the Parables. Okay. Written by Father Robert Sirico. He discusses how, and by the way, this would be kind of a classical education background idea. You want to read books that stand the test of time. Okay. In fact, to quote, I think it's Herodotus. He said, "I did not write this for an immediate public. I wrote this to last forever." Okay. So always find books that have stood the test of time. And I pointed out because whether people like it or not, the Bible, so thus far, like Herodotus and other works, have stood the test of time. And when Christ talks about the parables, he's talking about something that's physically true and spiritually true, which is just an interesting thing to think about. Some people say, "Oh, Jesus, was kind of a communist." Well, if he's talking about a guy selling everything he owns to go out buy something that he finds value in that no one else does, that's not exactly communist where I come from. Or when you talk about the parable of the talents, where there's 3 servants, 2 did pretty well. They doubled their money. 1 squandered it by putting it in a hole. Guess what? The master took away his talent. I find those to be irrehensibly capitalistic in nature. I find those to be very purposeful for life. And I think, reading that is really something that teaches you, if you've ever wondered if capitalism is a bad thing, by reading that, you think, wait a second, there's spiritual truths that we learn in capitalism that we might not always recognize at the same time. So I think that's another good book I'd recommend. And beyond that, anything you can get your hands on Buffett and Munger. But I'll go out one book. Damn Right is the name of the book. It's about Charlie Munger's life. I find Charlie Munger to be truly my idol. Okay. If someone says, "Cole, you talk very pointed, you talk very determined, you talk in a way that you're cutting black and white pictures." Yes, I really believe I am. And I really lean on Charlie Munger for that. I think he's done that correctly. I consider him the wisest person to walk the face of the earth. Is he perfect? No, I could tell you in another conversation over beer sometime where I think he's really wrong about certain things. But generally speaking, I like the way that Munger looks at things. I think at times that Buffett's trying to build his epitaph, and I don't think, to put in Munger parlance, I don't think he gives a damn. And I think I really appreciate his matter-of-factness in how he approaches people and subjects and discussions.
Absolutely. I've read a lot of Munger myself, so can agree wholeheartely.
Yeah, he's awesome.
To quote Taleb, nothing from the past 50 years is going to start with the classics.
Yeah, I totally agree. And by the way, here's the weird part. I mean, just a side note, in the 19th century, if you were a college educated person, that's all you studied was the classics. Mm-hmm. And it's very rare to find that in, call it US or Canadian or even European society. In fact, the father of classical education is really Ben Franklin. Ben Franklin created the University of Pennsylvania at that time to educate young men in a classical way. And now we don't educate young men or women in a classical way. And the question is, are we going to be better off for that? I'm voting no, just so we're on the same page. But it really, as we're asking this question, what's the value of a college education? I think we should be asking, what is the highest value of a college education? Because you just think, what are we talking about here investing? We're trying to talk about how we're going to learn to adapt to the problems of the future that we come across in markets and in interest rates and things of that nature. But we can't know the future, but we can learn to learn. And I think what I fear as a society is that in the Western world, we've tried to teach people that they can learn to know, and you cannot know the future. That's foolishness. And I think that's the real damage that we're starting to see in education.
Well, that's 50 minutes. I really appreciate your time. Maybe to wrap things up, I know you don't have all day. You have given a few suggestions on books for investors. If you were to advise the average investor out there these days, where would you point them nowadays if they're looking for investments? Like we said, maybe energy, or are you looking at tech, or where are you looking?
Yeah, most of good investing is just a negative R. You're trying to remove negatives. In other words, like to put it in Munger parlance, don't do stupid things like ignorance avoidance, like he always talks about. Okay. As soon as you can remove negatives or not do stupid things, you're already on the track to success. Okay. So I cannot highlight that enough. We were just talking about that earlier today. Like we just talked about, I would say read as much as you can. Also, do not believe that a lot of the behavioral truths. Like I think of like Daniel Kahneman and the work he's done, which I think is good work, but very few people can actually benefit from that work, in my opinion. When people say, oh, you can get rid of your behavioral biases and this and that, I don't believe that. I don't agree with that. That's wrong. People are made the way they are for a purpose, and it's tough for them to get rid of the way that they're made. So, when Charlie Munger was giving a talk to Caltech, this was like about a year and a half, 2 years ago. They said, oh, we got these behavioral finance things that we're going to help people become better investors. And I think Munger literally said, well, yeah, that's fine, but I don't think it's going to work. And he said, well, what do you mean? He said, well, I think you figure out whether you're a good poker player by go out playing poker. In other words, go out, take risk, learn from that, figure out how to eliminate the negatives or the mistakes you made, and go back and do it again and again and again and again. Because what you're really trying to build in that is cumulative advantage. So I always recommend to young people, go play poker, literally go play poker. You have to deal with risk management. You have a set chip stack. How do you place your bets? What are the odds based on what you can see and what you can't know? It's actually a lot more like the stock market. It's not a negative sum game. If you're playing with friends, for example, if you're at a house, they're going to take a VIG. That's a little more negative sum. But I just pointed out because that's a very healthy environment to understand, are you good at taking risks? And ultimately, that's what you're doing in investing.
Well, that's a great conversation. Thank you very much. If anyone wants to find you, not that you need the exposure, but you're at the website, Smead Capital, and you also have the podcast for anyone that is listening.
Yes, they can find us on the podcast, The Book with Legs. And then I've actually become a lot more active on Twitter. And I like to have fun with groups. So if you got good book recommendations, if your audience has books they want to throw out to me, I'm all ears. They can find us either at Smead Cap is our Twitter handle, or I'm at Cole_Smead. They can find me there, and or just shoot us an email. It's podcast@smeadcap.com. And we'd love to hear book recommendations because we're like I said, we just want to constantly be learning. And by the way, I want to say about out of our 40 episodes, I think we've used like 5 or 6 books that the audience came to us with and thought, oh my gosh, these people are way smarter than us.
Awesome. Well, we can end it there. Thank you very much. I appreciate your time.
Thanks, Trevor. Appreciate it.